I sent out a quick video recently on a new property that we just placed into service as a rental property, and I wanted to take a minute and kind of run through the numbers. Now, if you missed that video, I'm just going to tack it on to the end of this video since it was just a quick 2-minute walkthrough, but then you can actually see the property that we're actually talking about the numbers on. So this new property is over on Douglas Avenue, and we have a main house, and she rents for $16.50. We already have a lease on her. People are getting ready to move in. And then we have a mother-in-law's quarters that rents for $12.50. We're running applications on that right now, so we should have that person moving in any time now. So, but if you take those two, add them together and times it by 12, you end up with total rental income for the year at $34,800. Normally, we usually run about a 5% vacancy rate. Now, just to warn you here, the most vacancy rates run about 10% in residential rentals, but that usually assumes most properties are older properties, so they're much harder to rent. Our brand new houses, we usually end up having people fight over them, so our vacancy rate ends up actually much closer to a 5% vacancy rate. That means we can kind of expect net rents to be $33,060. Now, what ends up, we don't just put that in the bank, unfortunately, or actually we put that in the bank, but then we have some expenses. So first expense we can talk about is insurance. Insurance on this particular property runs about $2,100 a year. Now that's actually a lot lower than if you were to buy an older house. Brand new houses, since they're built to the most current hurricane codes, insurance is a lot lower. We have property taxes that we have to pay, so that ends up, the first year is actually only $400 because we're only paying tax on last year's value, which is only the lot. But I'm going to go ahead and budget $2,400 because we know eventually this will be, our property taxes will go up and they will assess the houses as well. Now, I do also always put in maintenance, even though we have very little maintenance the first, let's say, 5 years. We still go ahead and throw in a number, so I throw in 5% of the rental, so that ends up to $1,740. Again, there's very little maintenance on houses the first few years because the AC unit's new, the roof is new, everything's new, so there's very little maintenance on the first few years. Then we also have property management, and we pay right now. We pay 5%. So now, if you were to go at a house, you would usually pay 10 to 12. We have so many houses that we've negotiated that down to 5%. Also, part of that negotiation is our houses are all brand new. So when there's very little maintenance, and a lot of what property management does is handle maintenance calls. The garbage disposal is broken, the refrigerator's broken, this is broken, that is broken. We handle a lot of the maintenance ourselves because the houses are still under warranty, so there's a lot less management for the property manager to do. So then I've always also throw in a miscellaneous in there of $500 just for any contingencies that pop up that were not expected. So this ends up, we would make $24,580 total on the property after all the expenses. Now we're going to just talk about cap rate. Now, cap rate normally isn't for residential. They usually do cap rate for commercial type properties, but we're basically a commercial operation since we own several rental properties, so it is a useful tool. So we bought that lot for $25,000, and we put in our cost to build, we call sticks and bricks, was about $230,000 to build both of those houses. Now, I need to factor in some overhead because we do have superintendent fees, we do have cost in the actual company itself to build. So if we do $20,000, which again is kind of high, we usually average about $15,000 in overhead per house, but I'm going to just safe side it, and it makes the numbers a little bit cleaner. So we end up with $275,000 total cost of the property. Now our appraisal, actually let's talk about cap rate first. So we have $275,000 in the property. If you go back over here, we can make $24,580. So for simple math, let's just say $24,500, and we divide that by 275. That ends up with a cap rate of about 9%, which is a really good cap rate in residential rentals. Right now, multifamilies are going a brand new multifamily unit complex. For like apartment complexes where you usually see cap rates are going for like 5 and 6%, and that's because interest rates are so low. People are willing to pay more for cap rates. So because they're trying to get return on it, they're stretching for return, they're stretching for yield on investments. So this is a super good cap rate for what we're doing, especially on a residential rental. Usually they're much lower than commercial. Now, the reason why our cap rate is so well is because we're building it wholesale. So if we were to buy this thing retail, of course our cap rate would be much lower. But to talk about our equity ratio. Now, we had these appraised for upcoming loan. So, and they appraised at the property appraised for $345,000, or right at it. So, which is about right, because then when I looked at comps in the area, because you've got the main house, she's worth about $225, I'd say, and the back house is worth about $120, $130, because we can actually divide those up and sell them individually, or you can sell them as a group in the future. So if you take the $275,000, the $245,000, that gives us, right from the day we finished the properties, we ended up with $70,000 in equity in the property. So $70,000 equity in the property. That gives us 25%, 25% margin the day we placed them in service, which is a really good return on what we built versus what we could sell it for if we did want to sell them right away. So moving back to now, once we get the house done and we get it placed in service, we usually come in and we call strip the equity out of it. Basically, get a loan on the property so we can get our capital back, so we can do this all over again. So right now we can go get a loan for it. Now we could, in all actuality, because we have so much equity in this, we could go get a $275,000 loan. And some people would argue, hey, that's a good idea because now you get infinite return on investment because you got your money back, and then any money you make, you get a lot more. But we like to stay a little bit safer than just going ahead and stripping all the equity out of it. We like a little bit of a better margin of safety. Plus, we can get better interest rates if we get like a 70% loan to value. So in the long term, we think we'll maximize income and also protect the company by having a little bit better margin of safety. So we're going to end up getting a loan for about $250,000 on this property, and our current interest rate is 4%. We actually got 3.99 was what we were quoted on that, and a 240 month loan. So that ends up being over an entire year. That this would be principal and interest. So we're gonna principal and interest. So that ends up being $18,163, and that would end up being a cash flow of $6,417. So our income would actually be greater than this. This is just pure cash. This would be a pure cash flow because the principal, we're actually paying down principal. So our income is actually greater than this, but this is just more of a cash on cash return because it's simpler to calculate. So if we have $604,117, what we can make in income, what we have our budgeted income, and we have $275 in our, all cost. That includes our overhead, that includes our sticks and bricks cost to build, our overhead, our sticks and bricks, and our lot value. You add them all up, we have $275 cash into the property. Then you get a loan out of it, so now you have $25,000 in cash, because it's the $275 minus the $250 for the loan, the cash we get back into the company. So that ends up with a cash on cash return of 26%. cash on cash return, which is a good return. And again, there's a huge margin of safety in this asset because our loan is only $250,000. Our current value is $345, so we have a huge margin of safety in case the market was to go down dramatically. We have, if rents go down dramatically, we have another margin of safety. So we do like to be conservative on our numbers to make sure that we can protect the investors, but also grow the company. Which this is an excellent return. And remember, this is a cash on cash return. So year after year, that return goes up because that principal we pay down and down and down. So we're paying less and less interest and gaining more and more equity. So the curve ends up looking like this on our return. So I hope this was helpful, and I'll add that video to the end so you can actually see the properties. So I wanted to show you this house that we built here. This is going to be a rental house for us. And if you see, we really try and make the houses very traditional, so that way they don't go out of style. So this is a very traditional front. We usually put metal roofs on our rentals, so that way they last much longer, less maintenance on a metal roof. So, and then we usually try and do a 8-foot door walking in on all of our houses, so that it feels really big. It's 1,350 square feet, but it's 4 bedrooms, so it's pretty good size. For you got a bedroom here, then you got your master. We box up the ceilings to make it taller. You have your little master bathroom in here. So nice open kitchen design. That's what's real popular now. So nice cabinets, nice pools, stainless appliances. It's got a cool looking barn door here where you have your pantry and your laundry room in there. We want to maximize value and maximize our rent. So we build a house in the front, and then our neat little trick, there's a code that allows you to build a mother-in-law's quarters. This is the mother-in-law's quarters. We're finishing her up. We still got to put the back on the back side of the cabinets. If you do notice, white appliances. We normally don't put white appliances in because of COVID. We couldn't get a full set, so we ended up putting white cabinets. But it is a mother-in-law's quarters, so it's kind of small. So it makes for a nice little 2-bedroom, 1 bath. But she's only 900 square feet, but she feels pretty big. I mean, a decent size bathroom. And this is like a little small, almost 10 by 10 bedroom, kind of small, but again, for a mother-in-law's quarters, it is not bad at all.